Gustavo Medeiros. He's head of research at Ashmore Investment and joins us right now on the show. Gustavo, good having you. Thank you for taking the time out. And I dare say, if people thought that 2025 was yet another year of US exceptionalism, Europe is proving that wrong. Now, how constructive are you on what European indices would do or what have done till now and will do for the rest of the year based on all the capex plans that are coming in from Germany predominantly, but from the other countries as well?
Yeah, thank you very much for having me. It's a pleasure to be here. I think 2025 is a year, it shows us that you got to stay humble, right? Many of the the thesis that the American exceptionalism would continue forever has been challenged initially on capital markets due to the uncertainty in regards to the US policies. And then also the geopolitical turmoil that the new administration in the US has thrown the world has really galvanized the Europeans to move in a much bolder way than perhaps people expected. I think it was relatively well flagged, and you could see that by how European assets have been performing since last October, that Europe was moving away from its fiscal austerity. Germany in particular was moving away decisively. But I think that the magnitude of the impact and how quickly they managed to actually get the consensus for a 1 trillion euros fiscal stimulus that was approved shows us that has been partially due to the fact that there was this geopolitical tectonic shakes shifting. So that's nothing short of historical a change in Europe policy, and I think global portfolios are yet to global portfolio managers and global investors are yet to acknowledge these historical shift in portfolios, and that's going to have profound effects in global asset allocation, particularly as investors will have to diversify away from overbought, overly owned US stocks into the rest of the world, with implications beyond Europe into emerging markets, including India.
Right. Gustavo, Trump has kind of indicated that he will be flexible with the tariffs on, which are to be implemented on 2nd of April. How are you reading this, and how do you expect global markets to react to that?
I think tariffs, there are three broad objectives to them. This is what Trump, Bass, and other people are saying. It's an instrument to raise taxes. So think about it as a VAT, where foreigners pay part of that. Is also an instrument to get better reciprocity in terms of trade and get national security dynamics in favor of the United States. And thirdly is a negotiating tool. So what I'm expecting from the 2nd of April is mostly on the first leg of these three-legged objectives. So there will be some higher tariff element to tariffs will increase, and we should expect, even after the end of the tariff war negotiations towards the end of 2025, higher levels of tariffs. Again, I don't think that's going to be a game changer. I think the market has anticipated that. If you look at the dollar index, for example, it rallied from 100 to 110 after the Trump got elected, or before we thought that Trump would be in power to after the election, and we're back now to 104 levels, 103.5, 104 ballpark. So I think that is already pricing in some kind of manageable tariffs, something between 8 and 12% overall increase in tariffs, which after substitution effects could actually have a relatively mild impact on CPI depending on the way it's done. So in April the 2nd, we're actually going to know a little bit more about, I think in my view, the first leg of this tool, of this three-legged kind of like approach. But there will be some noises most likely coming as Trump tries to get further concessions away from different countries, particularly China and perhaps European Union. So I'd expect to see a jittery year in terms of 2025 performance.
Okay, just one quick follow-up there. So did I hear you straight that it's a jittery performance for markets for 2025, or are you bullish on Europe markets from here on for the rest of the year?
I'm bullish the rest of the world against the United States, but I think that the U.S. stock market peak is a process similar to what we've seen in 2022, perhaps, and that's going to be, it's likely to be a multi-week, multi-month process that we're starting to see. So I'd expect to see more bouts of volatility hitting markets in 2025.
Yeah, well, when the largest market goes through that, certainly there could be pain. Gustavo, I'm tempted to ask you before we wrap up very quickly. Do you look at India at all?
Absolutely. India is one of our,
Any thoughts?
main markets. Yes, I think structurally we're very, very bullish in India. Is perhaps the market with the most structural catalyst for an ongoing performance. But I have to say that within the last 24 months or so, before 2025, we've been having an underweight position in India on a tactical basis because valuations run ahead of themselves. And there was a big theme of people having zero exposure to China and having a lot of their portfolio in other countries, India being one of the deepest and most liquid market that you have alternatives, bringing this combination of locals and foreigners that were very, very bullish into the stock market. Now, more recently, we've reduced some of this underweight exposure over the last couple of weeks and months, to the extent that stocks traded at more reasonable level of valuation, particularly when you look at small and medium cap, small cap stocks, for example, traded pretty close to the average over the last 10 years, even though the average over the last 20 years is still one standard deviation expensive. But so, in a nutshell, we like India structurally. We think we were going to use more of these volatile market conditions in 2025 as opportunities to add into weakness in Indian stock markets vis-a-vis other emerging markets. But it's a position that have been holding a tactical underweight for a while. So that sell-off and relative correction between India and other emerging markets was welcoming for our portfolios, and I think is healthy for the long term of the capital market development within India as well.
Certainly. So, but tactically allocating to India, and I presume, Gustavo, Indian small caps. You find opportunities, selective opportunities that you find, you are looking at the small cap space as well.
Actually, Indian small caps are still overall relatively cautious, to the extent that, again, valuations are still relatively expensive. So we've been adding exposure more recently on the larger cap companies and names that have a higher beta effect. So we've seen the Nifty 50 today wiping out the losses that it had accumulated in 2025. And this relief rally, this rebound that we've seen was what we're actually trying to capture. And to that extent, you have actually better instruments, more liquid instruments to capture this rebound. I would cautious, the fact that we've having a strong week as we had last week, for example, and kind of like the magnitude of the relief rally comparable to 2022 being something that one has to bear in mind when making asset allocation decisions. These again, when we've seen relief rallies that are that vicious and that aggressive, that is less welcoming than a slow recovery from a bottom. That is what we like to see to actually call for a permanent bottom, right? So we're still not very, we're still cautious of companies that trade at very expensive levels of valuations. So I just mentioned the overall small cap and medium cap that were insanely expensive, trading at much more reasonable levels of valuations, but still tracking on the expensive side.
All right, we'll leave it at that. Thanks so much. Have a great day ahead. Much appreciated.
Thank you. My pleasure.